What's up, YouTube? Welcome to The Financial Twins. I'm Mark. And I'm James. And today we're going to be breaking down how to analyze an investment property. There are a lot of different types of housing investments out there. There are single family, small multifamily, 2 to 4 units, apartment complex, condos, townhomes, Airbnb, and more. Each has its own pros and cons. If you've never invested in real estate, this can be really intimidating. Today we are going to break down what you should be looking for in your real estate investments. If you are completely new to real estate investing, this video is perfect for you. First things first, you have to ask yourselves, what are your goals? What are you hoping to get out of this investment? Do you prefer having large cash flow every single month coming from rentals? Or would you prefer to focus on housing appreciation to build your wealth? Do you want the highest possible return on your investment and are willing to work more actively on this? Or do you want something more passive? How you answer this will play a large part in where you invest. For example, if you're looking for cheaper houses and want a consistent good cash flow and don't mind lower appreciation, then investing in places like the Midwest or the South is a really good idea. Most houses in that area are way cheaper than they are in, let's say, Seattle, Washington, or California. You can get massive cash flow from properties in the Midwest, but historically, houses don't go up in value very fast over there. The other thing you could be looking for would be house appreciation. Maybe you don't mind having less cash flow if the house keeps on growing consistently. Now, you can't always count on appreciation, and the past is never a guarantee of future results, but there are places that have higher appreciation relatively consistently. To find these places, we have to look at why houses go up in value. Now, there are a lot of factors in that, but the biggest and most obvious is supply versus demand. This means, to put it simply, places that have a supply that can't keep up with the demand will keep on rising. We can dive into this detail in another video, but to put it simply as we can, places in the Midwest usually don't have the population growth compared to the places in the West Coast. In growing places of population, you will likely have growing demand. Other aspects could be costs of house material in your area, how many contractors are in your area, requirements and times on permits, zoning laws, and others. An example of higher appreciating markets would be the West Coast, specifically towns or cities just outside major cities, places that, within a few years, will likely see a lot more development. This is called the path of progress. So now we have a rough idea of what different places would look like in the United States. So out of cash flow and appreciation, let's pick one. Let's say you want enough cash flow to cover all of your expenses, but really you want to focus on appreciation. Let's go find a good deal. How to spot a good deal. Here are a couple of tips and tricks that will help you find good deals. You will hear us talk about things like rules here. Just know that these are not actual rules and are more like general guidelines to help you quickly assess if a house is worth diving deeper on. The 1% rule. The 1% rule says that whatever the price of the home you are looking at, the rent should be 1% of the house's value per month. This means if you have a house worth $200,000, you should have rent that hits $2,000 a month before counting any expenses. Now let me break this down so that you can understand why it's not a rule, but a guideline. Let's say you find a property that hits the 1% rule. Great, but what if the interest rate is really high? What if the place has extremely high crime and high vacancy rates? What if there are a lot of big repairs like a damaged roof or foundation issues that will need to be repaired in the next few years? What if there's an extremely high property tax or flood insurance that cuts into your rental income? Any of these could sway the numbers to a point that the deal doesn't make sense anymore. The 1% rule is designed for you to look at a property and quickly go, okay, this house is worth $500,000 in my area. Do I think I can get $5,000 in rent a month? If it's a single family house in Seattle, it's unlikely you would get that rent for that price. So no, it won't work, and that's it. You move on to analyzing your next property. If you're in an area and a house is worth $200,000 and you see rent is for $2,000 in that area, then this house would be worth looking into more. Why 1%, you ask? Well, to help understand that, we need to go into the next rule. 50% rule. The 50% rule, again more like a guideline, says that you should estimate your operating expenses to be roughly 50% of your gross income. This means that with our last example of rent at $2,000 a month, you would expect about $1,000 in expenses per month, not including your mortgage. Again, this is not a rule, but a guideline that helps us assess what a potentially good property would be. As mentioned, there are a lot of other factors that could play into how expensive a house is to run a month. My house expenses per month is closer to 70% once you include the mortgage, but this helps us quickly do some math in our heads. If you are looking at a property worth $200,000 and research and see that you can get rents for $2,000 a month, you can quickly guess 50% of that income will be spent on expenses, leaving you $1,000 left over in a month. Then there are potentially other expenses like mortgages that would be another good chunk of that. Let's say $800. The house you're looking at could bring in $200 a month in profit, but it really depends on the real expenses. What we like to do is assume the expenses will be 0.7% of the total house value a month. We can get this number by analyzing a lot of houses in my area to see what the average expenses will be, even counting a mortgage. This means if I'm getting 1% in rent, then I'm getting 0.25% of my house value in rent a month in profits, at least before digging deeper. You get really good at analyzing once you've done it a few times, to the point that you can be doing the majority of these numbers in your head. This saves a bunch of time. Now that you have an idea of these general guidelines, you need to start digging a bit deeper. You could go to a real estate agent and see what they think, but it's really important for you to know what you are buying, and not blindly trust an agent who might just be trying to sell you a house. How to estimate rent. So, the next step would be to figure out what rents are going for in your area. There are many ways to do this, such as talking to the people you know, asking what part of the city they live in, how many bedrooms they have, and how much they pay. You can also just check online, on Zillow. They have a For Rent tab, or other major sites like apartments.com. One of my favorite ways for getting rental information in a short and easy way is to check out Rentometer.com. You can use it several times for free. Just input the address, the rent you think you'll be getting, how many bathrooms and beds, and then click Analyze. It will show you a range of rents in that area, what would be low, the average, and what is the highest. This site is a lifesaver, and they have an app that does the same thing too. Another life-saving tool would be the website Rent Cafe, which gives a really good breakdown of what is renting and for how much. You shouldn't rely just on one source of information. I highly advise you to look into all of these. If one is showing a dramatically different number, it's worth investigating why that is. Your rent will be one of the most important factors when buying an investment property. By now, you should be able to find out what rents to expect. Obviously, if your house is in really rough shape and small, it will likely be on the lower end. If it's really big and freshly remodeled, maybe it's on the higher end. It's really case by case, which is why it's so important to look into this yourself. I typically try to be conservative with my numbers to be on the safe side. I recommend you do the same. So you now know how to quickly assess if a place is worth looking into and what kind of returns you should be expecting. You can start looking deeper into your numbers and see how accurate they are. This can be as simple as Googling what to expect for costs. What to expect for expenses. The following list shows expenses you should have and a pretty good idea on costs before closing on the house. Property tax. Taxes can be dramatically different between cities and states. I would highly recommend Googling the area you are looking into and then talk to someone in the county who would be aware of the current taxes. If you Googled my city right now, you would think that my property tax is only 1.15%, because that's what it's been for years, and on a quick Google search, that's what shows up. But in my city, they increased the property tax to the highest legal limit to 2% in the past year, due to COVID hindering the tax gains to the city in 2020. If you had a $300,000 house thinking it's only a 1.15% taxes when really it's a 2% tax, that's over a $200 difference per month that you might not have expected. This number will be dramatically higher for more expensive property. Vacancy rates. Typically, investors put somewhere between 5 to 10% of the monthly rent into expecting a future vacancy or eviction. This again is very dependent on your area. You should be able to Google this by searching vacancy rate in city, where city is your city name. If vacancy is 5% on average, keep in mind that is only an average. If your house is in a bad district with potentially higher crime, vacancy rates could be higher there. Whatever your expected vacancy rates are, that is how much of the rent you should save, if not a little extra to be on the safer side. Repairs. There are two types of repairs: needing to call a handyman because your tenant needs something fixed, and a big expense like a roof. When house investors are talking about big expenses like the roof, they are typically referring to something called a capital expenditure, or CapEx for short. This repair category is saving for the handyman that has to come to your house. This will depend widely on what kind of condition your house is in and your tenant. Most of the time, investors save 5 to 10% of their monthly rent into this fund. I've also seen people expect to spend 1% of their house's worth in general repairs throughout the year. Depending on your property, this might be a good guideline. Again, Compare your numbers to all other numbers to see if this makes sense. Capital expenditures, also referred to as CapEx. These are the big expenses that can happen. Things like replacing a roof, needing completely new electrical boxes, and foundation needing to be fixed. These are usually huge costs that can't be paid up front. So we save every month for this. When you start looking at houses, you can pay for an inspector to do a deep inspection of what could be wrong with the property and approximately how long these things last. If the inspector says the roof has 5 years, Google the average cost of a roof and divide that by 5 years. Do this with all the big expenses. Once you have the amount all added up, save that much aside from the rent that comes in to be prepared for when these moments happen. Mortgage. The mortgage is how much you owe the bank for holding onto the loan. Every month, a portion of what you will pay goes into interest. The other part will go into paying off the loan, known as paying down the principal of the loan. Mortgages are on what is called an amortization schedule. What it basically means is that at the beginning of the loan, the majority of the payment will be towards the interest, while later on in the loan, there'll be a higher percent into the principal of the loan. An example of this would be in a $1,000 mortgage, the first payment could be 80% in interest payments, while only 20% goes down to paying off the loan. After 10 years, it's closer to a 50-50 split, and the last few payments of that $1,000, almost all of it will be towards the principal. Because you pay the majority of the interest up front, this is why you hear people paying extra payments towards principal, as it will dramatically reduce the years of the loan. If you had an extra $100 towards your principal every month, you could pay off your loan 5 years earlier. If you want an in-depth breakdown on amortization schedule and how they work, comment below. PMI. Do keep in mind that if you ever buy a house with less than 20% down, you will have to pay for an extra insurance called private mortgage insurance. It effectively is you having to pay extra for paying too little down. You are insuring the bank's money that they are giving you. Usually you can expect this cost to be 0.5% to 1.5% of the house's worth, depending on the house. House insurance. House insurance is a must. Never skimp on it. Depending on your area, you might need to get flood insurance or hurricane insurance. If you don't get the proper insurance and you lose your house due to a reason that you don't have covered, you could still owe the bank the entire mortgage. This can cripple people and is simply not worth the risk. The cost varies per state, but here in Washington, the average cost is around $900 a year, which is pretty much right where mine is at. That's roughly $75 a month. Utilities and garbage. Calling up your local utility place or asking previous landlords for electricity bills is a good way to find out what the price of this could be. Googling or calling for other utilities and amenities are really easy. You want to make sure you know the costs of water, garbage, gas, electricity, lawn care, and any other costs you could expect. Of course, you could have your tenants pay for all of these, but in some areas, that's just not possible. HOA fees. This usually only applies to condos and some townhomes, but in some cases, this can include other houses. HOA means Homeowner Association. Think of this like an apartment. If you own one unit but you all share the same roof, then everyone should pitch in to fix the roof. So there might be fees towards the HOA to pay towards the future repair. HOAs varies dramatically on the costs, depending on where you live. The people who are on the HOA could have specific rules that you don't like. HOAs can have some pretty crazy rules. I personally don't like HOAs because they can change rules and be very pricey. I know that some HOAs don't allow for short-term rentals like Airbnb to operate in their building. I've heard of one that doesn't allow welcome mats on your front porch, but usually HOAs exist to make sure that everyone can take care of their yards and keep things presentable. That way, you don't get that one neighbor with 15 cars all parked in front of their house blocking your road. But sometimes they can be a little over the top. Property management. If you want to have a less active role, you could hire a property manager. This could have its entire video just to cover this one topic. But just knowing how to find a rockstar property manager can be a bit challenging. Generally, property managers take about 8 to 12% of your monthly rent and might have higher fees under specific situations. Such as when screening tenants for your place, they might charge 50% for the first month. Although this costs a lot, it often will free up your time to look for good deals or spend time with your family. This way, real estate isn't as active. I highly recommend touching base with your property manager every single month, reviewing the documents that they send you monthly, if rent was paid, and what the breakdown of your expenses are. There you have it, an extensive guide on breaking down the costs of real estate investing. If you got this far, congrats. You now know how to break down a house to see if it's worth investing in. We hope this was clear. This had a lot of information, and I'm sure it can seem a bit daunting. Honestly, when it comes to houses, if you just go one step at a time, I think you'll realize how easy it is. The first house always seems to be the hardest, but once you get it, it becomes really easy to buy the next. You can be as strict with the numbers as you'd like. Let's say you crunch the numbers, and instead of a 1% rule, you only look for deals that would give you a 1.2% of the house's value. That would give you a lot more wiggle room in case there's any mistakes. I love houses because I believe that there is some form of real estate investing that could fit your personality. Maybe it's a single family house, maybe it's a commercial property, Airbnb, I don't know, but you can know if you just start looking. We hope you enjoyed the video. If you have any questions, please leave a comment below. We always reply to our comments and try to answer questions. If you want to reach out to us, our email is thefinancialtwins@gmail.com. If you liked this video, check out our other videos on why we think real estate is the best investment.